Hello, everyone. Welcome to the market update here for Tuesday, January the 24th. Again, if you have any questions during the week or any questions I don't get to here in the live class or any questions as you're reviewing the recording, make sure you send those to Jerry at TradersPro.com. I'll be happy to answer those for you. Just a quick reminder, we've had some issues with the audio in some of the classes. If you hear a clicking or there's a noise in the background that is annoying, please let me know so that I can dial back in, see if that seems to have gotten rid of the problem the last few times we've had it. And typically it's been in the stock specific class on Thursdays. I've been meaning to redo that class, just set up a whole new class to see if that fixes the problem. I think it's on GoToWebinar's end, because that's the only class that we seem to really have a problem with. But if it does happen in this class, let me know, and I'll be happy to dial back in to try to get rid of it. All right, let's get started. Obviously, markets have been resilient lately, and from what we were talking about on Thursday, it looked like we were bumping into that resistance line on the chart and moving back down. In fact, let's go to the chart real quick, and we'll come back to the direction alerts. There are a couple things on the direction alerts I want to point out. Now, we're going to look at a lot of longer term charts today, because what happened more specifically yesterday is something we just can't ignore. And what we've been talking about or watching for a while now is this downtrend line. And what was significant about yesterday is we finally closed above that downtrend line. Now, we did close off the highs of the day. In fact, one of the things that was unique about yesterday, I was watching it throughout the day, was because it was worrying me that we were breaking through that resistance. Let me zoom in and we can see the resistance there. Let's go to a 6-month chart, and I'll kind of draw in where that trend line is. Because we bounced, we got up to it right in through here, and then this was Wednesday's move where we dropped down on pretty good volume too, closed at the lows of the day. And then Thursday we had this little indecision day. Now, indecision days don't always mean reversal. They're just a pause. They're just a reevaluation. And so in that context, where you had a big down day and a little bit of a pause, I still felt like the VIX being as low as it was, I still felt like that we were going to continue lower. Friday, though, we had this move up, which isn't that big of a deal from the standpoint of it could have just been retesting that line again, trying to, kind of that last ditch effort to try to hang on. But yesterday, again, we closed above that trend line. Now, here we had the highs of the day were up here. And what was interesting is we were all the way up here at the highs of the day early in the day, but the volume was very light. And so you never trust a move on light volume, up or down. Volume is a really key indicator, and volume tells you the significance of the move. It's more significant if you have the higher volume. And what you're typically looking for is higher than average, higher than the average volume. But it was very light volume, and then it started to pull back, and we actually came all the way back down, almost to the trend line. We didn't quite get to the trend line, but we were dropping on higher volume. Volume was coming in higher on the drop. So that tells you that sellers were coming in at a greater rate at that point. And that's where the volume was starting to come from. And then it did try to rally a little bit into the close. It did move up a little bit into the close right here. And this is where it closed. It closed off the highs of the day. But I thought that was significant, that the volume that came in was when it was dropping. And man, there's so many mixed signals right now that I'd love to be able to look at that breakout and say, man, we're going higher here, and this is what I've been waiting for to turn bullish. But for every reason to turn bullish, there's still, a reason or two to remain bearish. and or at least be cautious. And so, as a technical trader, again, you don't want to start ignoring the charts and ignoring what the price action is actually doing. That's the whole point of being a trend trader, is to get rid of all the noise and the fundamentals, and let everybody else figure out what all that means. And I'm just going to focus on, what are you doing? Are you buying? Are you selling? That really is our primary goal. And to be honest, if I could probably do this class in 5 minutes by ignoring everything else and not talking about anything else or having any other opinions, and just look at what the chart is telling us, and for the most part just look at what the S&P is telling us, because that's the best index to follow. And we could be done in 10 minutes by just seeing exactly what the price is actually doing, and whether we're in a position to start getting aggressive with trades or not. But like I said, we're getting some of these mixed signals that are at least telling us to be cautious right here. Now, we do have a kind of a day today where, as of right now, it's kind of a matching high type of candle formation, which is kind of an exhaustion type formation. Now, again, we've got 2 hours before the market closes. That could change. And typically a matching high is, you'd like to see it this day close at the highs of the day, the next day kind of match that high, but not go above it. This is not the pure, as of right now, it's not a pure matching high, but the price action day where we open lower, we're trying to rally. It's looking a little bit exhausted now. It just could be that the market is waiting for Microsoft earnings. They're the big earnings that come out after the bell. Tesla also comes out this week. I think next week is going to be the biggest week we've seen in quite a while. We've got the Fed meeting on the 1st, a week from this Wednesday, which is obviously, we didn't have a Fed meeting in January, so everyone's going to be focused on that Fed meeting. We've got the jobs report, which I think is going to be the big indicator coming out on not this Friday, but the next Friday. What's that? February the 3rd. Because again, what the Fed is really looking at is they're looking at they're wanting the spending to stop. Okay, and so what's really going to affect that spending is layoffs. And by the way, this stop of spending will happen likely very, very quickly. If you think of your own situation, you may not be feeling the effects of a slowing economy just yet in your own personal life. You're still spending the same. You're still buying what you might be still traveling the same way, and we're seeing the airlines and the hotels have been doing very well. Those stocks have rallied quite a bit off their lows. But what's going to happen is it's going to be a sudden shock where either you're going to get laid off, or you're going to have associates at your job that get laid off. You survived, but they didn't. It could be a friend of yours that gets laid off. You're going to have a connection with one of these layoffs where you suddenly say, "Oh boy!" It may not be that you are forced to stop spending. As in the case if you're getting laid off, you immediately have to reevaluate your spending, cut the vacation that you were planning to do in the summer, obviously, unless you bought the tickets already or something. But you're going to immediately go into safety mode. But it could also be that your friend gets laid off and you say, "Oh boy, I better reevaluate my finances." The point is that it's not going to be something that's going to be gradual. It's something that's going to be it's going to trigger. It's going to be some news of and I think it's going to be that jobs report, or it could be that jobs report, where the whole market sees it and somebody reacts to it. But that's what worries me about jumping into a breakout right here, is knowing how quickly that can happen. And like I said, there's a lot of things out there that I keep talking about that have made me question whether we bottomed and are actually in a true new uptrend. The fact that we didn't get that panic sell-off, which always seems to happen on which does always happen on major corrections. There's other things out there that the market has never bottomed before being in a recession. Now, these are things that are becoming more and more common knowledge. I know CNBC talks about this stuff all the time, and so more people are aware of some of these things. When more people are aware of some of these things, they tend to not work as well. So I am. This is why I'm trying to focus on the charts as much as I can, because I recognize that could this be the time where it is different, and that's what's fooling everybody. The market will find a way to fool the most people as possible, is usually the case over the years, and that's why a lot of these things tend to play out. But I also know human nature, and I know that human nature tends to repeat itself pretty accurately, not always in exactly the same way. And so, could I see that the market will start breaking out and get people to think that maybe it's different this time, and then do what it always does, get the panic? Because again, what creates the panic sell-off? What creates a panic sell-off is when people now are no longer looking for a panic sell-off or expecting a panic sell-off, and then it happens. I think too many people are expecting a panic sell-off right now, which is why I can totally see where the market could fool us into looking like it's the worst is behind us, and then it hits us later on. Now, let me show you, going back to that longer term picture here, what I would be worried about, and that is that, and I think I talked a little bit about this last week, where let's see if I can go back a little bit further than 2 years. Let me try to go back to before the COVID low. So we get a little bit of context here. So, the thing I would worry about, and to be honest with you, this is already retraced about a third of that COVID low. It's already retraced enough to where this could be the correction, and it could be done. And you could make the argument that we're forming a little bit of an inverse head and shoulders pattern right here, and we've kind of broken. We initially have broken that downtrend line, but what I worry about is that this move might have been just wave A. This is A, B, C of wave B, and then we get that panic sell-off for wave C that brings us down to maybe at this point it'd probably come down to that 618 retracement, which is down probably around this 300 area, in that area there. So that's what I kind of worry about, where we do get a rally here, we do break out of this range, but it's just that tail end of wave B, and I could see where a rally like that would suck people back in, and people would be looking at breaking this trend line. Everyone would talk about breaking the trend line. The worst is behind us. We're going back into a bull market, and then. And if that's the case, this could be a very sharp move, a very quick rally, and then you have to, then that could maybe create the panic selling. Now, I do this all the time. When I start illustrating things in the future, again, it's very important to point out I'm not Nostradamus. I'm not trying to be Nostradamus. Not trying to predict anything. What I'm trying to do is be aware of possible outcomes. It's kind of like game planning for a football game or something like that. You don't know what the other team's going to throw at you or what they're going to do, but you look at their tendencies, you develop a plan to, if they do this, I want to do this. If I see them doing this, I want to do this. It's preparation for the unknown. Try to be ready for the unknown. And so in the meantime, could we find ways to trade this? Yeah. I mean, Thursday we may have a bunch of trades we can look to get into right now, stocks that look like they're taking off. We'll see. We'll see how things look up. I got a couple today that we'll go over. But by Thursday, we should have a little bit better idea of are we clearly breaking out of this range here. But that's just a longer term, again, outlook that you got to be aware of, at least be prepared for. Now, what would cause me to change that outlook a little bit? Well, obviously, what's going to be important is that is kind of how we rally up through here. Is this more impulsive? Does it look like people are starting to chase the move a little bit? That'd be something that would actually, again, being a contrarian, I'd be a little bit worried about trying to get caught up in that. It could be because again, bottoms. I go back to the what bottoms feel like. Bitcoin a while back, I did a class where I was talking about Bitcoin had just sold off again, and man, the FTX bankruptcy or meltdown was happening, and I said this is acting now like a bot. This is what you see at a bottom. Nobody wants to own anything. Nobody feels confident buying in. Nobody felt confident at the time buying Bitcoin. Everyone was bearish on cryptocurrencies in general. You start to see these bankruptcies start happening, big headline type bankruptcies, a lot of pain and suffering at bottoms, major bottoms. And you see that actually, we'll look at the Bitcoin chart here a little bit later in class. You're seeing that Bitcoin might be actually turning the corner a little bit. It may not be the bottom yet, but it's starting to show. It already had that condition that usually is a signal of a bottom, and then you start to look at the chart after that. There's a chart now acting like an uptrend. Part of the problem I'm having is that we never got that, like I said, that panic sell-off where nobody felt like they wanted to buy anything. In fact, there's just too many people, and especially if we break out of this range, there's going to be too many people that are going to be saying, "This is it, we're done," and the market going right back up. Not to mention that, like I said, you got Chairman Powell that doesn't want the market to take off right here. How can the market rally significantly if the Fed isn't helping? I don't know. Just be cautious. Don't be ready to jump into and just put your whole portfolio into the market at one time. Get into a few quality stocks because again, if it is breaking out, you want to have something, and that's why Thursday we'll look to get into something if we hold this breakout. We'll start adding some things to the portfolio. Some of the stocks that have good chart patterns look like they can continue to go higher. But we want to be very, very careful, at least right now. Like I said, I'd be a lot more confident if we had that flush out move and we were acting like this. Man, I would be a lot more confident that we were turning the corner and heading higher. So that's something to keep an eye on. It's funny. Last night, I was doing a little bit of prep for a class today, and if you remember, a couple weeks ago, I was going on a little bit of a rant about inflation and I was pointing out California, and again, if you're from California, I'm not trying to. I grew up in California, so I'm not trying to diss on your state, but there last summer when the oil prices were really high and people were dealing with record high inflation, California wanted to ease the pain of that inflation, and so they did send out checks, free money, to residents of California to ease the pain of inflation, to help with the inflation costs. Well, anyone that knows about economics knows that what inflation is too much spending. And when you have those stimulus checks, it just makes the inflation worse. I mean, it's laughable. It's completely ridiculous. That's only going to make the problem worse. There's no way it helps the problem. It only makes it worse. And what did I see as a headline last night? I wrote it down because I want to read it word for word. It said 63% of Americans support the idea of new stimulus checks to combat inflation. And then you start to realize there's 63% of idiots out there that don't understand economics and think that free money, everyone would love free money, but there's a price to pay. That free stimulus is going to be taken right back in the form of higher inflation. So, it makes me wonder, the Fed's got to look at that and just say, oh boy, if you think that if the Fed did see that, if you think that is going to encourage them to stop raising interest rates, it's going to have the complete opposite effect. So I don't know. I try not to get too caught up with the noise out there and the news and things like that, but you see some of those things and you just shake your head like, how can we get rid of inflation if this is the mindset out there? And I totally can see what Chairman Powell is trying to do and what he has to do if he's going to get rid of inflation. He's either going to get rid of inflation or he's going to prevent a recession. He's not going to do both. He's not going to be able to do both. And really, the focus should be on inflation. But see, nobody's dealt with inflation. Most of the people alive haven't really dealt with inflation because it was in the 70s. I was a kid in the 70s, so I don't remember inflation. And so I think that's part of the problem. People have already experienced recessions. They've already experienced the pain of recession, so they don't want that, but they don't realize that inflation is a harder problem to deal with. All right, so we'll keep an eye on that. Like I said, we barely broke out yesterday off the highs of the day, so it wasn't really a strong breakout. Now the breadth has been picking up, so there's been a lot of participation in the rally. So that is a healthy. There has been a healthy rally, and you've seen a lot of the chip stocks, tech stocks participating, which is that's the leadership. I keep talking about that's the leadership. But those charts are still lagging the others, and so that's where again you get those mixed signals out there. They should have been starting the rally higher, and it's just been the opposite. So it's again just those mixed signals have caused me to be a little bit more cautious. Now, if we have a clear move, if the Microsoft earnings come out good and like I said, I don't care what the news is. It's just that's what the market's focused on. I don't, not like you have to start following Microsoft it's just obviously the market is good. That's going to be the reason that people will use as to why they buying or selling if the market goes up or down tomorrow. But if it can hold that breakout there on Thursday, we'll start adding a couple things to portfolio there. I'll have a little bit more confidence adding some things at that point. All right, so now let's go back here real quick to the direction alerts. before we get into well, let's look at the indicators. Obviously, momentum. Again, what we're looking at here is, are we stretched? Is this rally we've had since the beginning of the year, is it getting stretched? Is it starting to get overbought? Not quite there yet. It's in the bullish trend, and so there is still room for it to go higher before it gets extreme. It's not in the extreme reversal risk. So momentum is still there. Momentum is fine. Breadth, as I mentioned earlier, we're starting to see, especially over the last couple of days, good participation in the rally. A lot of sectors participating. It's not just a couple of stocks that are leading the way higher. This definitely has room before it gets stretched. Again, what keeps worrying me is the sentiment is high and remains high, and it's extreme. We go back to this chart, you can see this is where all three of the indicators are on here. This is where everything is overbought if it gets above this range here. And you can see sentiment, look how stretched that is. It's just extreme. Now, it can stay extreme for a long time. We've talked about this. It's been extreme for a very long time. And so that alone, you can't, especially as a timing mechanism, you can't say, well, we're going to drop any day because sentiment is extreme. But what you need to start to pay attention to is when these other indicators start getting extreme as well. You get all three in there. That's when you're stretched. That's when you have to worry about a pullback. Now, the pullback is going to be important when we do pull back. Do we pull back in kind of a choppy, corrective type fashion? So we have this bullish move up, this impulsive move up. I always like to see the pullbacks. This is another reason why I don't want to chase the move right here. I want to see what the first pullback looks like. Is it more corrective, more choppy? It doesn't have to be a bullish ABC pattern, but is it more kind of choppy and sideways? That would lead me to believe that the next move should be up. Or do you have an impulsive move down? Is it a sharp sell-off where it just drops very, very suddenly and sharply? That really throws question marks into the rally. Is that a trend reversal? Because that's often the behavior you see at a trend reversal: impulsive up and then impulsive down. Now, sometimes you get impulsive up, impulsive down, impulsive up again. Sometimes you're getting these big, wild, impulsive moves back and forth. That's kind of what the bond market's doing lately, and I'll show you how I kind of deal with that when I see that type of behavior when we get to that chart. But you see that we're not too far away, and when the red line, when you see sentiment, and sentiment is above momentum, and then you see breadth, and all three of those get into this extreme risk, reversal risk range. It's a kind of a sign of a tired trend or market, and sometimes again, it doesn't mean you get a reversal right away or a pullback or a correction. It just means you want to recognize that you're in that condition. You don't want to get too aggressive in buying when you get into those types of conditions. So that's part of the problem here, is that we're trying to get the confirmation of the breakout, but once we do get the breakout, the market could push right into these extreme ranges here, stretched ranges here, where you have to be cautious again. So you just be prepared. We could have some periods, even if we do enter into some trades, we could have some periods where we're still kind of waiting and seeing. And now remember, you can alleviate an overbought condition by just moving sideways. You don't have to come back. You don't have to pull back significantly. And I can see that type of behavior in these conditions where there are a lot of mixed signals. I'm not the only one seeing mixed signals. A lot of traders are seeing mixed signals, and so they're the same way. They don't want to be aggressively buying. They don't want to be aggressively selling anything, and so you get a lot of these sideways moves when you're in that type of condition. If you look at we'll look at the charts again. We've had a lot of that back and forth lately, and that happens a lot. It takes some time for that behavior to change, to turn from being bearish to bullish or bullish to bearish. Sometimes it can take a little while to make those to have those transitions. And that's what sideways behavior is telling you, is indecision. And the bummer thing is that it's hard to make money in choppy sideways conditions. And so, nobody likes them because it's like, it's just, you just kind of, you end up working twice as hard for half as much money, is what I always say. And that's usually true. If you've ever tried to trade through a sideways condition, that's almost always the case. You're working really hard to try to find the stocks that are going to make you money, and you spend a lot of time, but because of the sluggishness of the market, you don't get the momentum behind some of those moves and as much as you'd like, or you don't get as many stocks. So that's, again, when money is easy to be made, it's when you're in those impulsive moves, and it's because, if you've got 85% of the stocks out there going up, your chances of picking the stock that's going up is easy, right? You could close your eyes and just pick a stock or throw a dart against a dartboard, and you're likely to find one of those 83% or 85% of the stocks that are moving up. When you're in a sluggish condition and you see stocks moving up, but there's only 10% of them moving up or 5% of them moving up, your chances of getting that 10% or 5% are a lot tougher. And now that's what the software is designed to do, is tell you what those 5% or 10% of the stocks are. That does help your probabilities there. But again, the tough part part of these conditions is that even the stocks that are finally exhibiting behaviors of an uptrend, if you've got the majority of stocks in a downtrend, in a bear market, it's just harder for those stocks to keep going higher. And a lot of times, by the time you recognize that they're in an uptrend, their strength rank is high enough, some of those stocks could be ready to roll over and correct. And you've probably seen it happen. It's just bear markets are hard. It's hard to make money in bear markets, or at least sideways markets for that matter. All right, so that's something to keep an eye on there. Now, the buy-sell ratios are stretched a little bit, but they can be more stretched. This is, they're a little bit wide right through here. But, we've seen, especially when we've had these sell-offs, they've gotten a little bit wider on the sell-offs. Could we see the same thing with buying taking off, where it gets a little bit more stretched? Yeah. So we're not extreme yet, but we are getting a little stretched as far as the range between the buys and the sells. This sentiment indicator is not too far away from extreme, but there's still room to run. So again, if we break out right here, we could easily see where we could still continue to go higher. And when those do get stretched, we'll recognize that and we'll point it out. And that's why there's a lot of days where we go through these direction alerts and they don't really tell us anything that's significant for now. But when they do, it's very helpful. It tells us when, it's dangerous to buy into the trend or sell into the trend if you're shorting, overbought, oversold conditions. But we're not there on those yet. Getting close, but we're not quite there yet. All right, let me go back to the chart. I can't remember what I was going to point out on the chart. I was going to come back to the chart, and then I was going to talk about something I forgot what I was going to talk about. All right, that's all right. I'm going to stick to this long-term context here a little bit, looking at these other charts. Now, the Dow, again, looks pretty bullish. This looks like a correct. You got impulsive down, and this was impulsive up, and then this is looking more corrective. You had lower highs through here, lower lows. But, during this rally up, kind of ended in December, but up until then, it had broken to a higher high right here. And then, like I said, this is looking more sideways. So the Dow, and we've talked about this, the Dow has definitely looked more bullish than the other indexes. Again, the problem is that typically the Dow industrials in particular aren't the ones leading. And I want to point out too, as far as mixed signals, when we get to the Dow transports, I want you to, and I'll bring in the DIA chart again, but I want you to see the difference in those two charts. How much the transports are lagging what the industrials are doing, or how the industrials look. That's not usually how it works. Usually the transportation stocks are leading the way, and the Dow industrials are following. And same thing with the chip stocks, although the chip stocks are starting to look more like leadership compared to the NASDAQ 100. But there again, you got transportation stocks aren't leading the industrials. Chip stocks are leading the NASDAQ 100, but there's a mixed signal there. It's like it's definitely adding to the confusion. We'd like to have a little bit more confidence in what we're seeing, instead of a lot of conflicting charts out there. One of them then is going to end up working, and if it whatever does, we'll follow it. But it's a little bit confusing time right now. So here's the Qs. Qs have been underperforming. We talked about that, although they've been outperforming lately. A lot of the rally has been. Yesterday, the NASDAQ 100 was up 2% compared to 1% with the S&P, so it's twice as much. So that is an indication of a healthy rally when the NASDAQ, and particularly the Russell 2000. Although the Russell wasn't as up as much as the NASDAQ 100, but it was, you see the small caps should be outperforming. Now the NASDAQ 100 did also close above its trend line. Oops, it did kind of break out. And again, so if that holds, you got the S&P and the NASDAQ 100 breaking out on the same day, which would be a little bit of a bullish sign right there. It's just, can it hold it? We'll see. Here's the Russell. Now the Russell again is looking like it could be kind of forming a little bit of a base right here, where you've now got a higher low. You're about to break out to a higher high right here. It already broke that downtrend line. I mean, there's a lot in the charts, like I said, that are looking like there's a transition to moving up. Again, the question is that just going to end up being wave A, wave B? You get a rally that's wave B, and then you get wave C. That's going to be the thing that we're going to really be watching over the next few months. All right, bond market. Again, this is what I was telling you, that you had this kind of impulsive move up, impulsive move down, impulsive move up. Now it's starting to kind of be a little bit more corrective, back and forth. What I've kind of identified here is this high and this low. If we break out above this high, that'd be bullish. Break down below this low would be bearish. Looks, especially as deep as we've gone right here, it looks more likely, we've retraced more than 61.8% of this move down. That was probably about the 618 retracement level, about right in here. We've broken above that. So the higher probability is that we're going to break to the upside. Now, if we look at a longer term chart of bonds, so the bond market is basically suggesting that that interest rates have peaked, that they're going to start to come down. That's what it's kind of predicting. Now that can change, and it doesn't mean the bond market is right. And so a couple of things that you're looking for, that I'm looking for here, is this, are we reversing the trend here? We did break the downtrend line. We broke the downtrend line, and then we came back and kind of tested. I don't have a straight line right here, but we kind of tested it right here, and then we're starting to move off it again. Obviously, if we break out above here, that'd be bullish. You'd have a higher low and a higher high. Could be acting like a trend reversal. This is always the tricky part about this. Is why it's still, even with as much chart analysis or chart, being able to read charts, there's always question marks, and one of them is you never know if this is the bottom and you're starting wave 1, wave 2, wave 3, 4, 5, and you're starting a new uptrend, or is this just wave A, wave B, and this does break out, but it's just wave C, and then you have another move down and bonds continue to go lower. Is this just a part of a correction of this larger downtrend? Now, there are a couple things that you could look at. One would be typically wave A and wave C are about the same length. So if this is a wave A and this move down is wave B and this is wave C, you could probably look to this area right here. Okay, if it starts breaking out above there, then obviously we're in a trend reversal. Now that lines up pretty close to this high right here. And so this is going to be a significant area right here, because not only if you break out above here, now you've got a wave C that's a lot longer than wave A, which is, it can be a little bit longer than wave A, but the longer it gets, the less likely it is that you're dealing with a bearish ABC pattern and that you're in a bullish trend. You'd also be breaking to a higher high right here. So here was the previous lower low. So, but whenever you have that, you want to look at what was the higher or lower high before that. This was the last lower high right here. You say, well, this is the lower high right here. Yeah, but that wasn't after or before the lower low. Here's the lower low right here. So this is a significant spot. So if we break above here, not only are we breaking to a higher high from this whole downtrend, but now you're stretching that being a bearish ABC pattern, not as likely to be a bearish ABC pattern. Significant probabilities of a bullish move up in bonds at that point. Now, that's a pretty far away, and you're saying, well, what do we do in the meantime? Well, I'm not saying you're not doing anything in the meantime. I'm just pointing out something in the future that is a significant spot. If we break out above here, then it's more likely that we're going to run up into here. Now, maybe we run up into here and it doesn't break out, and then you get a sharp move down. But I would tend to be very bullish in this short term, at least in bonds, in this area right through here. But it requires that we break out above this high first. And if it doesn't, and you suddenly see a drop, now what if we suddenly start dropping, the market sells off and we start dropping? Could it be that what it could be is, let me look at another possibility here. Let's erase those lines. This could be still the bottom right here. This could be that first impulsive move up. And could it be that this is wave A, B, and we get a drop down into here, wave C? And again, why do I stop right here on wave C? Because wave C tends to be about the same length as wave A. So if that's wave A, your wave C would probably come down to around here, not trying to be exact. And then you start rallying back up. And then at that point too, it could be that you could still have this being a bearish ABC pattern. That could still be wave A, wave B, and this is wave C. You still have to look at this area right here again. But that could explain how you could see the bond market sell off a little bit in the near term, but still be in this trend reversal. So down here will be significant to see how it acts when it gets down into this area right here. Does it keep dropping? Obviously, if it comes all the way back down to here, now you've got a wave C that's too long. It'd be much more like at that point you're going to break to a new low. Anyway, we'll deal with that if we get to that point. I just wanted to kind of just play around with that a little bit and show you some possibilities. And right now, what we're really going to focus on is, let's go 6-month chart. It's right here. We break out above here, bonds should be bullish for a little while. Gold continues to move up. Now, like I said, you don't always, it was getting into that extreme reversal risk range. And remember how I said you don't always have to pull back to alleviate that overbought condition. We've been moving a little bit sideways right here, and it's pushed us back into that buy range. Now, I also would point out that the chart is stretched a little bit, even though we're moving a little bit sideways right here. If it started to take off again, it'd push into extreme reversal risk range pretty quickly. It wouldn't take much to get it back in there. But so I wouldn't be jumping into gold right here because it could pull back. It could pull back a little bit. It could go sideways a little bit, then pull back. But trend is clearly up. And if you look at some of the long-term trends, in fact, this is really long-term, so just don't get crazy with this. But I just want to show you the potential. I can get a long-term chart quicker on this charting service. I'm going to do it with this one here. And I'm going to go to a monthly chart. Let's go to a monthly chart. So every bar represents a full month. So we're going back several years. And what it looks like we have right here is a cup with handle over several years, starting with the 2011 highs right here. You've kind of gone into this little bowl-shaped move right here. And then you've got that's the cup, and then this is the handle, and it looks like an ABC, bullish ABC correction right here that kind of forms the handle, and then we're taking off right here. If we break out above this range, that means gold going to all-time highs. Again, what's the rule of thumb with cup with handle formations? You can take the top of the cup to the bottom of the cup, and you project that distance upward. I mean, you can see where gold could go on a several-year run right here. I'm not saying it will. I'm just saying that the potential is there. Remember, the context of this is several years. So if you're going to run out there and say, I'm going to make money in the next 2 weeks, gold's going to go up to 250 and the GLD is going to go up to 250 in the next 2 weeks. Jerry talked about it in class. This handle pattern could last 2 more years. You could be sideways for a while before it breaks out. I just wanted to show you kind of the potential of this gold pattern that's now getting a little bit more exciting as we're seeing it finally start moving here. While we're here, let's look at the VIX. As usually, I'll come to the VIX chart here. But again, this is what worries me about the market rallying. How can we rally significantly with the VIX below 20? It's just going to be difficult, and it just makes me really hard to buy the breakout right here. This just tells me that it could be one of those sucker breakouts. Could be wrong. Like I said, this is not absolute, but it's one of the reasons that keeps causing me to be very cautious. Oil. What are we watching with oil? We're watching this high right here, and we did break above it. This intraday high yesterday did go above, but technically we have broken to a higher high right there. But again, if you look at the longer term chart of oil, it's been kind of slugging along here in this kind of sideways range. But obviously it's selling off a little bit today, but I do think it's significant if it gets above this high. It probably is going to work its way back up to this high up here. So why is this area significant? Well, that was the previous lower high before the last lower low right there. So there's a lower low. That was the previous lower high. Now we're breaking above that, so that'd be a higher high, not to mention the fact that you've got a higher low here and a higher high, already a higher high here. That behavior is acting more like an uptrend. Downward, a bearish candle there, so we'll see if there's a little bit of weakness here in the near term. We'll see this a little bit better on Thursday. But seeing that, I don't have a strong opinion on oil in the short term because it could go either way in the short term. The fact that it's a down day at that resistance area would lead me to be a little bit more bearish in the near term on oil. But we'll be watching for that. We'll see how that looks on Thursday. Dollar continues to move lower. It's moving sideways right now, but the previous move was down. Whenever you see a stock moving sideways, you want to pay attention to the direction it's moving before it moves sideways. That's where it's more likely to go after it's done moving sideways. However, we just got done making that argument with the SPY. We had that initial drop in December, then we moved sideways. We were expecting it to continue to move down, and we came all the way back up. So the trend is down in the dollar. We're assuming it's going to continue to move down. It's still acting like it is going to continue to move down, but we've already experienced the lower probability outcome off of that when you see it's moving sideways and the previous move was down. Could it happen with the dollar as well? Yeah. Could that be a little bit more bearish for the market if the dollar starts rallying? It would be, because the market is watching that and it is reacting to that relationship right now. But if it does drop lower, obviously that'd be a nice tailwind for the market to go higher. So that's something we'll keep an eye on as well. I talked about the VIX, chip stocks. Okay, so here's the SMH. I mentioned this Thursday. This is one of the reasons why I was turning more, or one of the bullish arguments for the market was that the chip stocks were starting to lead the NASDAQ 100. Now we're not above that August high. It's a significant high right there, but we did break out above this recent high. This is where we had that big bearish reversal in December. The market dropped. We're now clearly above that area, or we're not above that on the S&P yet or the NASDAQ. Actually, the NASDAQ might, I'll have to look at the NASDAQ chart. NASDAQ might have moved above, but what I want to compare it to is the October low. Look how far up above the October low we are. And then compare that to the QQQ. Yeah, so we're not above those December highs yet, nor November. Well, actually, that was a December high where it gapped up and then reversed. That was that CPI report day. But look again how we're not that far from the October low still on the Qs. So the chip stocks are up here in comparison. So they are leading the NASDAQ 100, which is why we look at that relationship. So they're leading, and that would be, again, a reason to be, you could use that as a reason to be bullish, except for the mixed signals we keep getting. There's really not a good argument to be strongly bearish or strongly bullish right now. There just isn't. I'm trying to look at which side is winning, and I just can't get a real confident sense of either side really winning just yet. Maybe a little bit edge to the bulls with some of these recent breakouts, but yeah, it's still a little bit of a tug of war going on. The transports, though, okay. So you see the transports. Let's look at the longer term chart because it's more, you can see it a little bit better in the transport. So the transports are I mean, you could make the argument this is an inverse head and shoulders pattern. By the way, this is the same thing you could look at with the chip stocks too. They are forming a possible inverse head and shoulders pattern. Could be breaking above here. But look at the transport chart in comparison with the Dow industrials, which is what we always compare them to, the transports and the industrials. It's called the Dow theory if you want to Google it. Look at how much stronger the industrials are compared to the transports. It's not supposed to be that way. The transports are supposed to be leading the industrials, not the other way around. Now, again, have there been moments where industrials have outperformed transports? And yeah, this isn't exact, but again, so what we have to do here is we have to say, okay, then the lower, we have to kind of embrace the lower probability outcome, which is this is the one time where it's different. It's different this time. It's always, 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 always dangerous to assume that this time it's different. Just always remember that. That's why I emphasized it. If you're finding yourself getting into, oh, maybe it's different this time, and you're quick to embrace it's different this time, I would rather embrace the probability and get burned a little bit by being wrong, and it did end up being different this time, than quickly embrace it's different this time and get burned all the time because you're always looking at the possible move instead of the probable move. Just be careful. Anytime I hear anybody start saying, well, I think it's different this time, it's going to be different this time, I'm like, that immediately sends up a red flag for me to say, okay, I'm not going to be quickly buying that guy's argument. I might get burned by digging in and going with the probability, but I always feel better doing that than quickly embracing the possibility. It's just because there's so many possible moves. You're just opening a door to really be undisciplined as a trader when you start embracing possible moves too easily. All right. Bitcoin. So again, it was back in this drop right here where I was talking about, because this is when we started to see the FTX bankruptcy and everything. I said, this is acting like this is what a bottom feels like. Nobody wants to own crypto. Nobody tells you to buy crypto. In fact, you almost looked as big stupid to buy crypto. Now, again, I have not been saying to buy crypto. I just, because like I said, I wanted to stay away from crypto, but I recognize that that's the condition. That is truly the condition, because if you have no desire to buy it, and nobody has a desire to buy it, that's what a bottom feels like. And if you could close your eyes and dig in, and the problem is picking the right one, because we don't know which ones are going to survive this whole thing at this point. But if you're a long-term Bitcoin or long-term crypto investor, I think Bitcoin will probably survive just because it's the kind of the biggest and the most popular. And it's kind of like Amazon was during the internet bubble. You knew that Amazon was going to survive. Some of the other smaller .coms weren't. But, now you've got a little bit of a base forming here. You're close to possibly breaking out above this area right here. So this is going to be critical, I think. We zoom back in. Let's just zoom back into that. So right in this area right here, if we can break out above there, it gets real interesting. Now you could wait because this is a pretty impulsive move up. So what I would probably look for is, can we break out on that impulsive move and then wait for the pullback, which will inevitably happen, because then that'll tell you, okay, how does it pull back? Does it pull back more choppy, more corrective looking? That would act like a trend reversal. Impulsive up then corrective. That's a bullish trend behavior. Or does it bump into this resistance as it has right here and then pull back right here? You could get that pullback and then wait for it to break out on the next move and then buy that breakout. Either way, you're still waiting for the pullback. Wait for the first pullback to see how it looks, just to make sure that it's starting to act like an uptrend, and then maybe get a little bit more aggressive there. But yeah, I mean, that's why I pointed that out, is because I wanted you to, if you've been following crypto and that's what a bottom feels like, is that type of behavior, and that's what we're expecting the market to go through, and the market hasn't gone through that yet. So that's what makes me really, really worried that we haven't bottomed yet. All right, boy, I did a lot of the market update part, but we had something to talk about finally. We're starting to break out, possibly right here. Let's go into just the muscle stocks, new buys, to see if we can find a couple patterns. I like this First Solar here, 98 strength rank. Switch this over to signals here. Nice little uptrend. Again, higher highs, higher lows. Recently broke to a higher high. Now, we did sell off a little bit right here. This could be, and today's a little bit of a bearish candle. It's a bearish inside day. That was a bullish candle here yesterday, and then a bearish inside. Could be a bearish reversal. So it might be this is an A, B, C. You get a little bit of a pullback, and then it goes again. So I wouldn't buy in on that type of a candle today, but this is one to keep an eye on. You could buy a breakout if it breaks out higher from here. You could buy the breakout there. Like I said, if it pulls back a little bit, then gives you a bullish candle, that'd be a good entry point. But I like the pattern. I like the chart pattern there. And we already looked at energy. Now, it's a different type of energy. It's not oil, but a lot of the energy stocks have done pretty well overall for the last year, and so this could be, this could continue that trend. Another one I like is this MOD 98 strength rank. We had a big bullish run up right here, long consolidation. And we broke out above that, and then we kind of come back and tested the breakout there, and then went back to a buy signal. Now, there's a bullish candle today, so you're in a buy signal. You could add that if you wanted to. I would probably put a stop down below this consolidation area. Because if it came back down and then back below that, because this is showing indecision right here. This is showing the market digesting this big run up right here. Buy. Should we keep buying? Should we sell? Keep buying, selling? Yeah, I don't know. Oh, we're going to buy. We sure that's where we want to buy? It pulls back to it. And if it keeps going up, then that's the buyers telling you that they're ready to take off again. If it comes back down in this indecision range and drops below it, well, it didn't drop below it all through here. Now it drops below it after breaking out. That'd be very bearish. I'd want to stop right there. That's when you know you're wrong, would be if it dropped below that point. I like the breakout. I like it's in a good trade management spot. All right. Oops, muscle stocks here. Let's do one more real quick. Let's do this PDD. I think this is one of those Chinese stocks which have really taken off a lot lately. But again, I love the pattern. Bullish move right here, pull back, broke out to higher high. This was a higher low, and then it's consolidated through here. Looks like it might have put in its higher low right there. A little bit of an exhaustive move on these 2 days right here, but maybe it'll wait for Microsoft earnings. But this looks like it could take off. You could wait for it to break out above there to a new high as an entry. You could have a tight stop below that low, or a little bit wider stop below this low to manage. The reason why I don't like a tight stop right here is that could it be this is a wave A, wave B, and you still get a wave C down, but it's still a higher low. That could happen. That's why you like to give it a little bit of room. Or you could have a tight stop with the idea that you don't trust the rally. I don't want to risk very much if I'm wrong. If the market does break out, take off from here, I should be fine with a stop right there. You can manage it that way. The key is making sure you understand your plan and that you know why you're putting your stop where you're putting it, and then following through with it, making sure you don't suddenly, I'm going to change my mind and move it back down a little bit here. You don't want to get into that game. All right, that's all I have for today. We'll see what happens between now and Thursday. We'll try to just have a brief. If the market holds this breakout, we'll try to have just a brief update. That's why I spent a little bit more time on the update today. This is normally what I do. I'll spend this class mostly on the update, and then usually in a bull market, we're spending all Thursday with most of Thursday with finding patterns and trades, ideas, and things like that. So if that's the case, we hold the breakout. I'll do try to keep it a brief market update, and then we'll try to see if we can get some trade ideas, and then maybe add something to a portfolio to get something going there in case this does continue to rally higher. So until then, we'll see you Thursday for the stock specific class. Have a great week, everyone. Bye now.